It's another late night. Maybe you're pulling an all-nighter for some work or school project, or you can't sleep and you're flipping through the channels, if that's still a thing, and you come across an infomercial. Some guy in a shiny suit and a Bob Barker microphone walking on a blue soundstage with a captive audience cheering his every word. What's he selling? Empowerment! A bona fide can't-lose way to outsmart the system. Open a self-directed IRA and put real estate inside it. Yeah, don't do that. Hello everyone and welcome to Just the Tax. This is my little channel about spreading the good word of financial literacy so it's more than just the tax. Real CPA here, and today we're going to talk about the top 10 reasons why you should never put real estate in an IRA. Sheesh, I can't believe this even needs to be said. First things first, what is an IRA? Well, we covered that in an earlier video, but we'll recap it quickly here. First, IRA stands for Individual Retirement Account, and it lets you set aside money for retirement. It's kind of in the name. They come in two varieties. Traditional, which is where you deduct the money you put in now and you pay tax on it later when you take it out, and Roth, where you pay tax on it now, but you don't pay tax later when you take it out. So now let's get into it. The first reason why you should not put real estate in an IRA. IRAs require that a trustee holds the assets for your benefit, and the IRA cannot be your mattress. Tell that to the guy in the shiny suit and the Bob Barker microphone. He doesn't know what that even means. Number two, the assets in the IRA can't be the type that produce trade or business income. If you're flipping houses, that would create something called UBIT, unrelated business income tax, and it's 35%. Reason number three, real estate requires maintenance. Performing maintenance on real estate in an IRA is something called a disqualified self-dealing transaction under Internal Revenue Code section 4975, subparagraph E, subparagraph 2, subparagraph C. Ain't that a mouthful? It basically means that the entire property would be deemed to be distributed at its full fair market value and subject to income tax and early withdrawal penalties. And the guy in the shiny suit and the Bob Barker microphone doesn't know that either. Reason number four, you can't use the property yourself. Putting an office building for your business or a vacation property in there, even if you pay a fair market rent, won't get you out of this rule. Reason number five, if you overpaid for your real estate and the cash flow isn't enough to cover your expenses, you can't just contribute more money to the IRA because there are annual limits about how much you can put in each year. And if you exceed those limits, you pay a 6% excise tax. And as my father would say, son, would you like to pay your taxes or would you like to pay your taxes with interest and penalty? See, who says accountants don't have a sense of humor? Okay, 5 reasons down, halfway through. Quick disclaimer, this is for educational purposes only. I'm not selling you anything. I will ask for your like, share, and subscribe if you find this video helpful to you or someone you know. I am at Real CPA, but I'm not your CPA. Hashtag not tax advice. Let's get back to it. We got 5 more reasons, let's go to it. Reason number 6. Okay, so you ignored this advice and you put real estate in an IRA. Good for you, way to beat that system. And now you made it to retirement age. Good for you again, you made it that long. Well, now it's time to take an RMD, required minimum distribution. How do you do that? What do you like, take the door off the hinges or something? Go ask the guy with the shiny suit and the Bob Barker microphone, maybe he knows. Reason number 7, did you buy that real estate with cash? Good for you. Well, most people lever up and take out a mortgage for real estate. Well, guess what? For real estate in an IRA that's subject to a mortgage, you may need to file this form 990T. It's that whole pesky UBIT thing again. Remember, UBIT is unrelated business income tax. Speaking of UBIT, this is reason number 8. If your IRA owes it because you put real estate in it and you pay the UBIT out of the IRA, that's a distribution, subject to tax and early withdrawal penalties. Reason number 9. Did your real estate happen to come with some land? Well, guess what? Land needs to be valued by the trustee every year. And also, you can't be your own trustee. In other words, this is an unnecessary expense. Each year, I thought IRAs were for saving money. And reason number 10, if you own real estate outside of an IRA and sell it, you get capital gains treatments, meaning lower taxes. But if you have it inside an IRA, you get ordinary income treatment, meaning higher taxes. Ding, 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 way to beat the system. Alrighty, that was 10 reasons why not to put real estate in an IRA. But here's one more, it's a bonus. If you sell your real estate for a loss, which can happen, outside of an IRA, you can get a deduction. Inside the IRA, you get nothing. Most important, if you take nothing else out of this video, don't put real estate in an IRA. I mean, I couldn't make that any clearer, right? Okay, so that's the video. I hope you enjoyed it and learned something from it.